You're listening to the Decisive Podcast, insights and analysis to empower confident decision-making. Hello, and welcome to the Decisive Podcast. I'm your host, Kristen and Ken. Today, we're diving into a topic that's been on everyone's mind, inflation. As economies around the world grapple with the after effects of multiple shocks, think about the COVID pandemic, conflicts including Russia-Ukraine and Israel-Hamas, supply chain disruptions, just to name a few. Rising prices have become a pressing concern for consumers, businesses, and policymakers alike. Ken Wattret, Vice President of Global Economics at S&P Global Market Intelligence, joins me to explore the current inflation trends, the factors driving these changes, and what they mean for the global economy. We'll also discuss the differences between core and headline inflation, the potential impact of recent trade policies, and how these dynamics are influencing consumer behavior and business decisions. So whether you're an economist, a business owner, or just curious about what's happening in the economy, you won't want to miss what Ken has to say. Let's get started. Ken, it's great to have you back on The Decisive. Thank you for being here.
Thank you very much for having me.
So, Ken, could you provide an overview of the current inflation trends globally?
Well, inflation dynamics and inflation prospects vary across countries, but in big picture terms, most national consumer price inflation rates have been trending down from their pandemic-driven peaks back in 2022 and 2023. Now, this being said, although inflation rates have come down a long way in most countries, in many of them, inflation remains above the level which the central bank is targeting. Now, in the initial stages of those post-pandemic declines, inflation rates fell rather quickly. There were various reasons for that, including favorable base effects, but the main reason was that supply chain disruptions, which had characterized the COVID-19 period, they eased off. But the final mile of the disinflationary process can be quite difficult to achieve. And that's because inflation rates for some goods, and particularly some services, tend to be quite sticky. Now, we also have some crosswinds to consider present when it comes to inflation prospects. On the upside, we've got higher tariffs as a potential source of pressure on inflation rates. And then to the downside, we've got moderations in some commodity prices, including crude oil prices, and weakening demand conditions are also leaning downwards.
Sticky, that's definitely a good descriptive word. I'm going to steal that word from you, Ken. Now, could you explain the difference between core inflation and headline inflation in the context of the current economic climate? Why is it important to monitor both?
Well, put simply, headline consumer price inflation includes all of the changes in the prices of items in the typical consumer basket of goods and services. And that's usually the inflation rate that the central bank would aim to achieve, as it's the broadest measure of price pressures. Now, there are also numerous core measures of inflation, and we track many of those. We calculate some that are not officially available as well. And the main reason for doing that is to get a better handle on the underlying dynamics of inflation. The most common core inflation rate will exclude changes in food and energy prices. Those prices can be rather volatile, and they're often influenced by factors which the central bank generally can't control. Think, for example, about drought conditions pushing up agricultural prices and food inflation, for example. In those circumstances, the central bank will be focused on the potential for what we would call second-round effects on inflation. In other words, whether a jump in food or energy prices will be followed by a pickup in inflation expectations, and then wage and unit labor cost growth rates go up. And that ultimately leads to a more generalized rise in inflation rather than a pickup in inflation due to, one specific area of the basket. The general point about assessing core as well as headline inflation rates is that by digging deeper into the breakdown of the inflation figures, we can better understand what's driving the trend in inflation. And that should hopefully improve our ability to predict how it will evolve in the future.
All right, that's really helpful. Thank you, Ken, for explaining it so clearly. So, how are these inflation trends influenced by recent trade policies, particularly in the US? Historically, do we tend to see a direct correlation between tariff adjustments and consumer price inflation?
Well, obviously, tariffs are the hot topic of the moment. And again, to put it simply, higher tariffs raise prices for the importers of goods, and typically that will be businesses. How much of the tariff related increase in their costs is then passed on to consumers will determine the impact of the tariff on inflation. And the circumstances can often vary. So if demand conditions are weak, importers may need to absorb some or all of the increase in their costs via reduction in their profit margins. On the contrary, if demand conditions are robust, then it's more likely that most of the cost increase or all of it will eventually be passed through to consumers, raising consumer price inflation. And then in turn, that will squeeze household real income growth and normally consumer spending as a consequence. Now, that's what we expect will be happening in the US over the next several months. And it's clear that the Federal Reserve is concerned about that prospect, and that stopped reducing interest rates, even though other central banks carried on cutting. And that raises an interesting question. Should a central bank react to a tariff increase and change monetary policy as a consequence? Now, the theory on this is that it ought not to, as a tariff increase leads to a one-off increase in the price level, not a persistent generalized increase in inflation. But if there's a deluge of tariff increases and that leads to a sustained upward shift in households' inflation expectations, this could have longer lasting effects on inflation. And the Fed is rightly concerned about that risk.
That certainly is a very interesting question. Lots to watch there. So, Ken, in your report on inflation indications, that report mentions lowered commodity price assumptions. Could you elaborate on how these changes are affecting inflation forecasts and what this means for consumers and for businesses?
Well, we're very fortunate at S&P Global Market Intelligence that we can use the expertise of our colleagues who track and forecast commodity price movements as an input into our own inflation projections. And in recent months, we've seen downward pressure on crude oil prices, for example, as expectations of global demand for oil have shifted downwards as economic prospects have worsened. And at the same time, supply expectations have stepped up. And energy prices typically have one of the highest weights in the consumer price index in most countries. Obviously, energy bills account for a big chunk of household expenditure. And as energy price prospects shift downwards, then this automatically leans down on our inflation forecast. Now, at face value, that's pretty good news because lower consumer price inflation, other things equal, implies higher household real income growth, and normally consumer spending improves as a consequence. And the second factor is because lower inflation normally means lower interest rates. Now, there are some caveats to highlight regarding the beneficial effects on economic conditions that I'm talking about. One is that part of the reason for the fall in oil prices is weaker demand. And so that's implying that underlying growth conditions are worsening. And another thing to consider is that lower commodity prices are positive for commodity importers, but they're not necessarily positive for the countries producing and exporting the commodities. So how we gauge the impact of changes in commodity prices on inflation and economic conditions will vary depending on the country that we're looking at.
Results may vary. Got it. So, Ken, given the current economic indicators and trade uncertainties, What are your projections for inflation rates in the US and globally over the next few years?
Well, I've talked a lot about variations in our forecasts, and that again applies here. The inflation forecast for all the countries that we will cover will differ, reflecting differences in many of the factors that drive consumer price inflation rates. For example, domestic demand conditions, the tightness or otherwise of labor markets, sensitivities to swings in commodity prices and differences in the weights of items in the basket. Those and other factors contribute to these variations in inflation rates and dynamics. If we think about the US, first of all, our near-term forecast for the US is quite unusual compared to most countries at present, in the sense that, the Fed has succeeded in bringing inflation down towards its target rate of around 2%. That's for core PCE inflation. But it's now worried that inflation is going to pick up again, and that's primarily due to the effects of higher tariffs on US imports. Elsewhere, we generally expect the downward trends in consumer price inflation rates, which have been evident for the last few years, to continue over the next couple of years, again, with variations at national level for all the reasons I've highlighted. And that's because the US is increasing tariffs on a much higher share of its imports than all the other countries. So tariffs should be making more of a difference to US inflation than to inflation dynamics in other countries. Big picture wise, demand conditions generally look subdued, and we also see little evidence of the kind of supply chain disruptions that we were seeing during the pandemic related period. Now, one area which we will be monitoring closely is the breakdown of core inflation between goods, excluding food and energy, and services. Now, those core goods inflation rates, they're generally quite sensitive to global factors like changes in commodity prices and supply chain conditions. And core goods inflation is generally low in most countries currently, but it's starting to rise, and tariffs are a likely source of upward pressure as we move through the remainder of this year. Services inflation rates, they're typically more labor cost driven and sensitive to domestic economic circumstances. And those rates are more elevated currently, but they're on a downward trend. And given the high weight of services in most consumer price indices, how those prices evolve are going to be pivotal to inflation prospects. Our assumption is that services inflation rates will continue the gradual downward trend that we've seen. If that doesn't happen, then we could end up with some rather uncomfortable decisions for central banks to make, because inflation could again prove rather sticky.
There's that word again, sticky. So, given everything that we've been discussing, Ken, how might we see central banks in advanced economies responding to the expected evolution of inflation?
Well, for the US, we expect that we'll be headed into a period of weaker demand growth. And as that weakness becomes apparent, that may then open the door to US rate cuts resuming. Looking beyond the US, the general trend globally is towards more monetary policy easing as inflation rates moderate, and that allows central banks to be more sensitive to the signs of slowing economic growth that we've seen, partly related to all of the uncertainties surrounding US trade policy and tariffs and so on. And by region, Western Europe has been leading the charge recently with rate cuts, and that's partly because economic conditions have been relatively weak in Western Europe. The European Central Bank has halved the level of its policy rates compared to where they peaked back in 2023, in contrast to the Fed's recent inaction. And we also need to mention in this context the weakness of the US dollar recently. That's really important because that increases the potential for more monetary policy easing in emerging economies. Traditionally, they worry when the dollar's strong about their currencies depreciating and importing more inflation. They also worry about possible capital flight pushing their currencies down. But if the dollar's softening and their currencies are appreciating, those concerns are diminishing, and that opens the door for them to continue to lower policy rates. Again, it's a familiar theme. It's not a uniform picture. The idiosyncrasies of national economic conditions will continue to influence our forecasts for the 200 plus countries that we cover.
200 plus. That's a long list. Lots to watch there. And again, that reminder that results may vary. So, Ken, how do you think inflation trends and policy uncertainties are affecting consumer behavior and purchasing decisions in advanced economies, including the US?
Yeah, that's a really interesting issue. In the period since the trade tensions began to escalate in early 2025, we've seen a very pronounced decline in consumer confidence in the US. And uncertainty over policy, particularly regarding trade developments, has been a key contributory factor to that. Now, we have in the very recent past seen a bit of an improvement in US consumer sentiment, and that's because there's been a de-escalation of tariff-related tensions. But those surveys still remain well below, the levels that we were seeing in 2024 before all of this policy uncertainty arose. Now, all this being said, consumer sentiment surveys are not always a reliable guide to actual trends in spending. Other factors can be more important. Inflation's been coming down. It may pick up again, but it has been coming down, and that's been beneficial for household spending, which has looked pretty solid so far. So it appears that, consumers are worried about the outlook deteriorating, but so far it hasn't really been impacting on their spending behavior. Outside of the US, the picture is very mixed, again, reflecting, variations in national economic circumstances and prospects. But, what we see across the board is policy-related uncertainty has been a common theme. That's impacting across a very wide range of sentiment surveys.
Policy uncertainty is not necessarily something we all want to have in common, but there it is. So, Ken, how could businesses incorporate these economic insights into their decision making?
Well, based on the information that we're seeing, it seems that they already are. I mean, for example, the economic data that we're looking at is indicating that there's been a lot of front loading of economic activity to try to avoid the effects of higher tariffs. That's particularly evident in the trade figures, including in the US, where we saw imports really soar in the first quarter of 2025. And the counterpart of that strength in US imports has been the exports of many countries into the US. We think that's probably given a kind of misleadingly positive impression of economic conditions recently. So we need to be careful that we don't extrapolate those trends in the trade data, because there's likely to be a correction after those front-loading effects. We've already seen some signs of that in the trade data for April in the US. We've also seen some of those front-loading effects in our purchasing managers indexes, with the data for manufacturing and trade, which were really struggling in mid-2024, actually picking up a bit in the early part of 2025. But if we look beyond those sectors, the PMIs are giving us a pretty clear indication that beyond those front-loading effects, global economic growth is losing momentum. And to illustrate that, the global composite PMI output index, which is a good bellwether for global growth momentum, that averaged just 51 in the first 2 months of the second quarter of this year, down by about a percentage point from its average in the first quarter. And that is a level that is normally consistent with very sluggish global economic growth.
Yes, we do value our PMI data for those early warning signals, early signs there. Now, Ken, we could easily go on, but it's time to wrap up our conversation on inflation. Any final thoughts or takeaways for our listeners today?
Well, perhaps maybe to put some of the developments that we've been talking about recently into a broader context. I mean, if we look back to the period from the late 1990s through to the COVID-19 pandemic in 2020, the situation was characterized by generally low and relatively stable inflation rates. For various reasons, those inflation rates have become more unstable and unpredictable, and they matter a great deal to economic prospects, for various reasons, as already explained, directly through their impact on household real incomes and spending, and indirectly through their implications for central bank monetary policy and financial conditions. And in this more uncertain world that we're living in, understanding the details of what's driving inflation, having a good handle on how inflation rates are likely to evolve, and understanding the implications of that is pivotal really to any assessment of economic and financial prospects. And that's where we come in, economists providing analysis and inputs on all of those issues.
Thank you for listening to the Decisive Podcast from S&P Global. Please subscribe and join us for next week's episode. Until then, stay curious and stay informed.